Hello everyone. Today's big question, are we in a bear market rally or is it time? Are we going to see the bull run? Is it the switcheroony? Well, it's hard to say, right? There's a lot of uncertainty in the market, a lot of things going on internationally with China and Europe, and we're still dealing with our own stuff. But I think we can all agree, like, eventually stocks will go back up. Eventually. And is this the time? That is the question. So to answer that question, let's look at what the pros have to say right here.
We are. I mean, we do think that the S&P 500 and other risk markets in the short term can trade higher. This is the view of my colleague Michael Wilson, Morgan Stanley's CIO and chief equity strategist. And I think he had a well-timed call last Monday that the S&P could trade up towards 4,100. Some of the more tactical indicators that we follow are showing a favorable kind of oversold condition and some healing of key metrics. So, look, in the short term, we think we can get some relief. The fact that earnings season is also been relatively strong is also helpful. But big picture, I don't think this changes it. We still view this as a bear market rally rather than the start of a larger new bull market move.
These rallies are great. We deserve them. We just, so desperately want to think that this is the end of the bear market. And in our view, we're getting near. We're probably 90% into this bear market, and the market seemingly is already pricing in the Fed action, is pricing in the inflation, is pricing in the consumer confidence, but we still have the earnings revisions that are not fully priced in our view. So we are expecting another leg down. So as much as we want to be excited about these rallies and they're positive, and we should definitely be taking advantage of them, we think that we are not quite done yet, not quite at the bottom.
So they're saying we're not quite done yet, right? We'll see some progression. We'll see that 4,100 mark, right? 4,100 on the S&P 500. That's about 5-6% from where we are now at 3,860. So we could see us hit that. We could see this nice bear market rally, and you can capitalize on those gains, right? You should try to if you're swing trading. But you have to be careful that we will most likely see that turn back down, hit potentially lower lows, go back to recent lows, and you got to be careful of that. But once again, that gives us an opportunity. Gives us an opportunity to either short the market around the 4,100 mark, back down, and it gives us the opportunity to pick up these stocks again, right? Everyone seems pretty greedy right now, very quickly. Everyone very quickly switched from being very fearful to greedy. And that's never a good sign. We like to have a more solid base when we are building a nice trend upward. It's a more solid base. We don't want to see a volatile base. We don't want to see a greedy base. So once people, if it goes back down and we're still in the bear market, try to capitalize when people get fearful again. Because we know that, okay, we needed this downturn. We need to price in more stuff. And then hopefully this base gets built more sturdy. So what might be some of those indicators that we should build off of? One big one is the bond yields, right? Having these high bond yields puts a cap on how high stocks can essentially go. Seeing the 3-month above 4, seeing the 10-year above 4, it caps out how high and how much hedge funds want to put into stocks when they can see such healthy returns in these short, midterm bond yields. So once we see bonds rotate down, once we see the yields rotate down and stocks look more appealing, that it should be a sturdier base, right? When we have bonds, when we have these yields above 4%, it really doesn't give a sign that stocks are a great option, right? The opportunity cost is not there because a more risky 7, 8, 9, 10% return in the stock market versus a guaranteed 4% in a bond, the opportunity cost isn't there for these hedge funds. So we really have to wait for these yields to start going down for stocks to have that sturdy base that is needed. So that's something to look at. Like look at these yields right now, right? The 3-month above 4, and has just been rallying like crazy, right? From 1% to 4% in the last 6 months. The 10-year, very similar chart, right? Going from 2%, from high 2s up to 4 as well. So we have to wait for these to start coming back down before stocks look healthy enough and look good enough and cheap enough to buy. And so that's something that we should really be looking for. And one of the main indicators I am looking at to see the long-term trend in stocks, not this potential bear market rally that we're seeing now.